Welcome to the show.
All right.
Another
Here we
week.
Go. Yep. Getting close to the summer. May begins the first 6 months of what historically, seasonally, are the worst 6 months of the year for stocks.
Oh, yay.
So how about a positive spin and a negative spin? If we're going to have gains this year, at least some of the gains are going to happen in some of the worst 6 months historically of the year. On the positive side, November and December could be huge because May, June, July, August, September, October are the 6 worst months historically. And November, December are the first 2 months of the best 6. And so maybe we keep going lower into the early summer and get a big second half. I mean, who knows? There's all kinds of possibilities flying around the internet. Fortunately, we just respond to the market and don't try to predict it because everybody predicting, I mean, half are going to be right and half are going to be wrong. And it never seems to matter when people are wrong. They just come back the next day and say something else. And
yeah, there's one thing that I've learned in this business is it's okay to say whatever you want to as long as you're not managing people's money.
Yeah.
Because most of these people that you hear on TV, I would count maybe 1 out of 100 that actually manage people's money. You know, they might be investing their own, but even then, when you actually get to talk to some of these people, they're not managing it the way they say out loud.
Yeah.
So what I mean by all that is that you have to take a lot of that stuff with a grain of salt, right? Because it's one thing to have your opinions, and like Jerry said, you can be half right and half wrong, and then you turn around the next day and, you completely change your opinion. It's all well and good because it's not really hurting anybody, quote unquote, but it kind of is because you're influencing people, right? So on one side, if they're not managing people's money, then they're not hurting anybody by their poor advice.
Yeah.
But they're influencing people to make decisions, and that part's a little frustrating because I wish there was a little bit more transparency.
I like how Thoughtful Money, Adam Taggart.
Yeah.
He always in his intros for the guests that he has, he always talks about whether they're, what their background is, and he makes sure to say whether or not they're actual money managers.
Yeah, and that's the anomaly, right? What I'm really talking about is Bloomberg and CNBC, and I'm talking about the major, where most of the people, get their day-to-day advice from, right? If you're reading Barron's or Forbes or whatever, any of those publications, I even caught like this. I was going to take a snapshot of it, and I just forgot, like a screenshot. I had these 2 articles back to back. I think it was in Barron's. I can't remember. I subscribe to quite a bit of these stuff. I tend to like to read my news instead of like watch it because I get so, yeah. But anyway, completely contradictory articles about the same topic, like next to each other, and you see that often. But it struck me as like kind of the reality for the average investor who's trying to figure this stuff out. If you're doing things like watching Thoughtful Money, it's the reason why we watch it is because they're credible, right? They're transparent. They are transparent, and they some of them are RIAs, investment advisors. They're money managers. Yeah, so there's credibility there because they know the consequences of their actions and their talk. But that's an anomaly, right? I think, and you're going to find a few of those out there. And of course, that's on YouTube. That's not on mainstream television, where most people, I guess a lot of people get their stuff from social media too. So I actually started following a guy that I thought was a finance guy, and it turns out he's a real estate guy, but just happens to, know a lot about finance. Has to have a finance degree because some of the stuff's pretty intricate, but he's very transparent, and that's how I found out he was in real estate and not in regular finance. But yeah, we hopefully you guys get the feeling that we're pretty transparent, here on this show, because we try to let you guys know where we're coming from on stuff.
There's always a bullish perspective and a bearish perspective.
Oh, of course. It could go either way any day.
Yeah.
Like today looks great.
Yeah.
I mean, it's 10 o'clock in the morning, so we can take that with a grain of salt. But it's crazy, and we used to talk about this a lot, and I think it's way more applicable now, where a lot of the rules have just gone out the window. I read a really good research article recently that talked about. I wish I was good at like repeating that stuff, but it's so deep in the weeds about fixed income, right? And how fixed income has just been turned upside down, meaning mostly bonds, right? It took me a while to figure out what fixed income really meant, but things that people use generally to hedge when the market is going down. In these times, right? What people would argue is, well, I got 40% of my portfolio in bonds, and yes, they're not, it's not a massive rate of return, but it keeps me moving forward. And that, of course, the one going up versus the other going down, that has all changed. But it's not even that. It's just really how a lot of these bonds are even put together. Like that's a whole other thing. That's just
ladders and things.
Ladders is another one, but just the what's actually in them, and I'm using bonds as a big, term. There's, just so many different kind of fixed income assets that you don't even know are out there. That are, this is why I was doing the research, is because they're increasingly becoming, accessible to retail investors instead of just accredited investors. And, there's limits to, like, you can only use up to 10% of your net worth or your income. So, still keeps you some limits on it. But giving you access to it is huge, because some of these are packaged in a way that they are doing okay. They are giving you a solid, 8% return in a year, and you get quarterly, payback. And, like, that stuff exists. It's usually only applicable to people with a lot of money. But I know I'm kind of
No, it's ironic because obviously the G fund gets the biggest rap in TSP, but there are plenty of really smart people out there trying to figure out how to get a rate of return that's 5% in this environment. It's really hard.
People would kill for that. I know it's. I hope people are realizing it now, because people don't get smart until we get this kind of like chaos. Yeah. We've talked about it 100 times, a million times in the past 5 years that we've been doing this. Well, 5 years that we've been doing this, like with the show and everything. People just don't get really interested when everything's rosy.
Nope.
They only get really focused when all hell is breaking loose. And this is an example of it, where I saw two different custodians, and those are like the people that allow you to, they hold the money and move the money for advisors, right? And so one that we're pretty familiar with, Altruist, there's another one. They've created these basically G funds that are pulling 4% plus. And that is just amazing, right? Because most advisors don't have access to that. Yep. We in TSP have access to it all day long. Yep. And people don't respect the G fund for what it is.
They don't understand.
It gets so much hate.
It's really simple, right? The G fund gives you essentially a 10-year yield rate of return for a savings account. So if you put your money in a bank, you're getting what, like 1% or whatever, right? In a savings account. Maybe. But that means you can go withdraw it every day. The G fund is the same thing, because you can move your money in, and you can't withdraw. Obviously, it's in the TSP, but you can move. You have access to that money. You can move back and forth between the stock funds and all that. But you get a rate of return that in the real world you would have to lock up your money for 10 years. I mean, now these days short-term rates are higher than long-term rates, which is upside down anyway. But the fact that you can get a 10-year rate of return for zero risk, because these bond ladders are not risk-free. They're super conservative, and then that's the goal of what they're trying to do, is make it as minimize risk as possible. But they're definitely not risk-free to the principal. And the G fund, somebody had put that up on Facebook the other day, is the G fund still safe because of all the things that are going on? If the U.S. defaults on its debt obligations, then the G fund's not really safe. It's the same as a debt obligation like anything else. But if we get to that point, we got some much bigger problems to worry about.
It won't just be the price of eggs we're crying.
No, price of eggs and whatever other else. Yeah, that's part of the big problem too. Is that the market's moving on a news cycle, and it's not moving based on fundamentals or even really technicals. I mean, technicals can definitely help, but none of the rules are, like I said, none of the rules apply. So let's see what we can do to kind of figure it out a little bit. So we'll take a look at what happened this week, the macro stuff, and then what actually mattered. It was quite a bit early in the week, and just talk a little bit about how to keep emotions in check. And then I'm going to do kind of I got 3 charts that show the daily S&P 500. And this is kind of the level of detail that we do for subscribers. So if you're interested in this level of stuff, definitely sign up for the newsletter. And then the regular TSP fund charts that we do. So Monday was a big down day, right? It was down 2.36%. We had the 3-month and 6-month Treasury bill auction. So we talked about this last week. If investors are not willing to invest in the United States, meaning buy U.S. debt, our rates go up. And so the 3-month sold for 2.25%, and the 6-month was 4.225, and the 6-month was 4.05. In a normal market, you should get paid more, meaning the interest rate should be higher, the rate of return should be higher if you're locking up your money for 6 months versus if you're only locking it up for 3 months. So it's what's called an inverted yield. And it's not good. It's not like normal. People are more worried about, what's happening in the near term than what's happening than the risk of what's going to happen later, which is more of an unknown. It's not good. On the positive side, Tuesday, M2 money supply comes out. So it increased to 21.76 trillion in March after increasing to 21.67 trillion in February. S&P is up, recovered basically all the gains from the losses on Monday. But M2 is one of those kind of finance economic terms that it's really kind of important. So it's the supply. It measures the total amount of money available in the economy. It's cash, checking account, savings account, and all other liquid assets. So it's trying to figure out how much sort of disposable money is in the system. And that's a big piece of inflation. And so inflation and current interest rates have major ramifications for the general economy as they heavily influence job availability, consumer spending, business investment, right? You have to have available cash to do all those things. So the Federal Reserve has the dual mandate of price stability and maximum sustained employment. So one of the ways it works to maintain price stability is by manipulating the M2 money supply. When it decreases interest rates, it puts more money into the system. When it increases interest rates, it makes it so that you have to pay more for debt, so it's taking money out of the system. So it's not like the Fed is keeping track of how much cash you have in your wallet or in your bank account. But it has a pretty good idea of how much cash the population in general has at any given time. The important point isn't the number, but how the number is increasing or decreasing from month to month. Cash seen as a warning sign of a growing inflation threat. And so this is it only goes back to 2015, which seems like from our perspective, it's a pretty long way back there. But in reality, if you looked at this number going way back, it just keeps going up. This decline in M2 money supply was really big in 2022. And that's one of the big reasons that a lot of economists were calling for a recession, because you never see a decrease in money supply. After the COVID, right, we had the Fed comes in with all that stimulus, and we had a huge increase in the money supply. And it's turning back up, right? So money, and it hit new highs. That was kind of the big takeaway this week. Money supply, M2 got higher than the previous high in 2022, and it's still going up. So that's actually good, because the more money in the system, the higher the stock market tends to go. Wednesday, mortgage rates go up again, right? They've been going up for the last couple of weeks. They're at 6.9% from 6.81 last week. New applications dropped 12.7% after dropping 8.5% last week. So still very tough if you're trying to buy a house. S&P's up 1.67%. Then on Thursday, the Richmond Fed Manufacturing Index fell 13. It basically starts at a baseline of 0, falls 13 after falling 4 last month. Manufacturing is slowing across the country. You got, I think, 13 feds around the country. We talked about the New York Manufacturing Index last week. It's down. Richmond is down. Philly is down. Manufacturing is definitely decreasing. Initial jobless claims ticked up a little bit. Not a whole lot, but that's the first kind of somewhat decent uptick. If we get above 300,000 jobs, that's really something to start looking at. If we start seeing increasing jobless claims, that's really the last shoe to fall before we get into recession. And continuing claims were basically flat. S&P is up 2% on Thursday. And then on Friday, we had Michigan consumer sentiment came out at 52.2 versus 57 last month. So it shouldn't be a surprise to anybody. Consumer sentiment is falling. And the S&P was pretty much flat to down as of about 10 o'clock on Friday morning. So the big things this week, right? Last weekend was pretty big. Pope Francis died on Easter Sunday. Klaus Schwab, if you don't know who he is, it probably doesn't matter anymore because he just stepped down as the executive chairman of the World Economic Forum. But he founded this thing in the 1950s. If you guys have ever heard of Davos, it's an annual meeting of all the super rich and influencer people in the world, along with the heads of most countries, and they basically sit around and decide what's gonna be the fate of the rest of us. But this is where all the green stuff, green initiatives and everything else came from the World Economic Forum, along with a whole bunch of other things. But apparently, Klaus Schwab is accused anyway of using a bunch of money from the World Economic Forum for personal reasons, and he resigned abruptly and denied everything, and says he's going to sue anybody that talks about it. So we shall see what happens with that. But all that happened over the weekend, and it certainly contributed. Oh, and Trump repeated statements over the weekend about how he wants to fire Powell. So all that definitely unnerved the market and had a big role in Monday's 2+% sell-off. Then, of course, the next day, Bessent, Treasury Secretary, comes out and says, nope, he expects that there will be a de-escalation in the trade war with China in the very near future, calling sky-high tariff fight unsustainable, and the market's looking for any reason to rally. Of course, take that. Rally big on Tuesday. Wednesday, Trump reverses his stance on firing the Fed chairman, says he never had the intention to do it, which is ridiculous if you've been watching the news cycle. And then he says that the 145% tariffs on China are going to come down dramatically, and the market was up big on Wednesday, and then it completely reversed. It's still finished up for the day, but reversed big on Wednesday. And then Thursday, the mega cap tech names had been beaten down for months, but for whatever reason they caught a big bid. Microsoft, Amazon, Nvidia, Tesla, all are up over 3%. And so, as we know, the mega caps are still on a cap weighted S&P 500. Those companies are still the ones that affect the index the most. And so the fact that those were up well over 3% pulled the S&P up over right about 2% for Thursday. And then Friday, Beijing and the White House at odds publicly about whether or not tariff negotiations are going on. Trump is all over the place talking about how, we're in deep negotiations with China, and China's saying, no, there's no negotiations happening. And it's, we'll see what happens today. It's all about the news cycle, which is really unfortunate. So how do you keep emotions in check when it's day-to-day markets flailing based on the news cycle? Stop watching the news. That's probably certainly the thing that I've done. I mean, I watch the headlines just to kind of see what's going on, but that's really it. It does nothing more than make you second guess how you think you want to manage your TSP.
It's just confusing. It has been, even if you're not even talking about financial stuff, you're talking about current affairs. We used to be in a job where when we were working in this operations center, we had TV screens everywhere. Yeah. And so it would be on because you needed to know if something bad just happened or whatever, because you're going to get it faster from that than you are pretty much anything else, right? But I haven't. That's like over 10 years ago for me. And recently I was in a gym that I don't usually go to these kind of gyms, but I was in there and getting a workout, and it's one of those that has TV screens all the way across, and you could see all of them, right? And we know what they all are, and it's not. I have no agenda with the politics of them, but it literally was like opposite, same thing going on.
Same thing.
And I was like,
opposite.
oh, this is crazy. This is why I don't watch it anymore. And so definitely for current affairs, and even more so for something as specific as, I would call it financial literacy. Don't watch the news. It's not going to help you, because it's just going to confuse you. And they just got time to fill, so they got to talk.
Creates a lot of anxiety.
Yeah, I mean, I stopped watching Bloomberg. What I do is actually record the shows that I want to see, and then it's old school. Like I feel like I'm TiVoing it. But yeah, I record it and I go back and I watch that show instead of watching it, randomly. But anyway, yeah, I agree with that. Stop watching the news. Yeah. Don't stop watching this podcast though.
No, definitely not. I mean, that's what we're trying to do, is decipher all this stuff in a small enough chunk that is valuable. Definitely follow the weekly charts, not the daily charts. Daily charts are going to go flying up and down, intraday, all over the place. The weekly charts, how the weekends, is much more important than how any day within the weekends, especially given the TSP rules, following the charts day to day. I mean, you have to make a decision on a day, but in general, the weekly charts are way, way better. And while you're following the weekly charts, all you have to know is what the key levels are, right? There are key breakout levels and key support and resistance levels. And as long as you know what those are, you can just glance up and see what the numbers are that day, and you know where you are. You know whether you're at a place where you have to make a decision, or it's just up and down, and it doesn't matter. And that, of course, goes to your risk tolerance. I mean, if you can't stomach the volatility that's happening in the market now, we had like 19 days this year where the market was up or down more than, I think it was 1%. It might have been 2%. I don't think we've had that many 2% move. But one of the things JC had put out in an email pretty recently was this idea of the VIX, and it's kind of cool. If you divide the number that the VIX is by 16, so if the VIX is 32, divide by 16, it's 2, right? That's the percent move that you should expect the market to do on any given day. So if the VIX is 32, you're looking for a 2% move up or down, as long as the VIX is up at the 32 level. So if you can't stomach that level of volatility, hang out in the G fund. I mean, there's nothing wrong with that. Okay. All right. So rather than trying to figure out which way the market is going to go, it's much better to just be on the right side of the trend, right? One of the most simple ways to figure out which side of the trend is to draw a trend line. I mean, they call it that for a reason. So here's the top in 2022. The market comes down. Big, huge rally here, right? You don't know how far it's going to fall here. It puts in a bottom, a big, huge rally. It does not make a higher high. So now we have a higher low. It rolls over. Or lower high, rather. It rolls over. Puts in a lower low, right? So now we have a lower high and a lower low. We're in a downtrend, no doubt. Rallies again. Puts in another lower high. But now you have 3 points that you can connect. So you draw the trend line. Rolls over, puts in another lower low. So we're in downtrend. Comes up, hits the trend line again, rolls over, right? So now we got another point on the trend line. But this time, it puts in a higher low. That's your first indication that maybe the trend is changing. Once it breaks and put in a higher high relative to this one, and came back down and put in a higher low. Now we have an uptrend. Right? That's it. Hopefully that's kind of simple. Right? As long as you keep having lower highs, the trend is down. Once you start getting higher lows, the trend is up. Okay. That's trend lines. So if you just draw, it doesn't have to be exact. It's not going to be exact. There's going to be little overshoots and, but you can get a really good idea of the trend by drawing a trend line. This is just a straight waterfall down. I mean, you can draw a trend line, right? You can connect the highs, and obviously the trend is down. But it's so straight down, it's almost, on this scale, it's not worth it. It's just one move down still. All right, that's trend lines. The next one that's super simple too is the 200-day moving average line. As long as price is above the 200-day moving average line, it's going up. Right? Once it's below the 200-day moving average line, nothing good is happening down there. Right? And if the longer it stays down there, the lower price goes. Then once it gets back above it, you're good. I mean, you could just use the 200-day moving average line if you're looking at the charts every day to be on the right side of the trend. You're not going to catch the exact tops and bottoms. You're not going to get the recovery rallies. But if you want to be on the right side of the long-term trend, that's a really good way to avoid big declines and stay in for the big moves higher. This is really frustrating because it's gone straight down and we've been below that 200-day moving average line for a while. And this move back up is a huge percentage move. So that's where FOMO comes in. Everybody gets all, I could have made all this money back if I had stayed in the stock funds, right? You don't know how low this is going to go. You still don't know. All right, so that's kind of the big picture of it, right? So if we zoom in, this is where we're at. This was the top on February 19th, okay? This is the 20-day moving average line. This is the 200-day moving average line. And this is the 200-week moving average line. So if you've seen the show before, we've talked about it in the last couple of weeks, the 200-week moving average line is really the long-term support. It's gotten support there. We had a little bit of a overshoot in COVID, but it's gotten support at that 200-week moving average line ever since it got back above it back in 2009, after the low in 2009. So this is a really important support level, okay, if we were to get there. So if you're a bear, you're thinking price is going to come down and hit that 200-week moving average line. And if you're really bearish, you think it's going to keep going down, right? So if you're a bear,
what kind of percentage is that?
This is about 12-14% down.
Yeah, because that puts it in perspective. Because it looks like a long way down. Yeah. It's not.
It's not. No.
That's not a 40% drop.
No.
Which is what if you're watching a lot of the people we do, like it goes from I've seen people call for 40%. I think that's a little excessive, but it could happen. And then, the other way, which is we just got a V bottom and we're rocking. Yep. We're going high. Both of those could be right. But let's talk about more in the middle, where it could be, which is more practical, is what Jerry is showing you, which is a good probability it's going to test that 200-week or get close.
Yes.
And so that's only 12% away. Now, 12% is a lot. I'm not saying it's not a lot.
It was only 3% down here.
Yeah.
It almost tagged it.
Yeah, that's where I was going next. I mean, look how close it got. So that's highly probable, just in the practicality of the way the market needs correct. And this is where I tend to start falling right now, is a lot of people taking kind of the long-term view think this is a necessity. Right? A lot of things are overvalued, have been for the longest time. It was great, the sun was shining every day and everybody's just skyrocketing. But a lot of these companies just weren't worth it, right? The value really wasn't there. And this is going to get the market is going to correct to a point where it gets the fair value, right? So you're going to be paying what you really should for these companies. Now, the good thing is again, because the market kind of figures it out, especially when we're talking about the S&P 500, you got 500 companies, the value will continue to increase, at a normal rate or whatever, right? And we'll get back up there. But it needed this kind of breathing room. And all that, to me, makes sense. Because, again, most people forget these aren't just dots on a screen, these are companies and they're run by people. And investors are people, right? The market is people. And with all of this volatility and all of this going on, it gave us a needed opportunity to kind of take a deep breath, let the market kind of not expand, what the other would contract, so all of that kind of makes sense. Now it sucks when you're in the contraction and you weren't watching and you weren't paying attention.
You don't understand why it's doing what it's doing.
Yeah, well, you're blaming it on the administration and you'll find a thing to blame it for, and you could be right. It doesn't matter why. I've gotten over why a long time ago. I don't care why it's happened. So, a lot of friends of mine that are not in this world with us and they're actually outside of the government have lost a lot in their 401k and are just finding, like, what do I do now? And like, well, you don't have a lot of choices. You stayed in, right? So, I mean, you wouldn't get out at the bottom, which is what a lot of people are going to do, right?
Yeah.
But anyway, the point here is, going back to the chart, is keep that in perspective. Like it's not the world is falling if that goes down to the 200 week.
No, it's not falling. If it goes below the 200,
then we got a whole different problem. Let's worry about that when it happens. Yeah. But it wouldn't be that big of a deal if it did that. And it's a 12%. It's what I wanted to point out with that is it's not that far. Because when you just look at that line, you go think to yourself, oh my God, we got like a 50% drop there. Not really. It's not. Yeah, because you can't see all the numbers. Yep. I just wanted to point that out. So put all that in perspective, but it is highly probable, historically, what Jerry said in the beginning of this podcast, we're getting ready to come into a point of the year where historically is the worst time of the year. All of these other things are going on at the same time. Why would it be out of the realm of possibilities or probabilities for that to go down and test the 200? It wouldn't be.
It will at some point, someday. I mean, whether or not it does on this cycle, right?
Yeah.
So like we said, there are plenty of people that say this is the bottom, and we're getting, we're going on to new highs. It's a V bottom, and that's it. Their crystal ball says that. There are other people that are saying this was the first leg down. This is going to be a recovery rally, and then we get a big move to the downside. So,
which is very practical.
Which is very possible too. If you're actually trying to figure out what to do, you got two choices. You can go with the people that think that this is a V bottom, or go with the people that think this is a recovery rally and a move down, or you can look at it and go, okay, I'm going to know what's going to happen. For now, we have this down-sloping trend line, right? We got above it a little bit on Friday or on Thursday. You can get over it a little bit. That's fine. It could roll over from here and come back up and test it again. It can keep on doing that, right? That's certainly a possibility. Another possibility is this is the 200-week moving average line, right? If we get up to here and then roll over
20-week.
200 day.
Sorry, I know it's not the 200 week. That's the one on the bottom.
Yep, this is the 200 week.
Yeah.
This is the 200 day, right? The black one is the 20 day. So yeah, it's very possible that we get this. I mean, we talked about it for a while. This face ripping rally, right? That 10% day is not it. That's not the rally that's gonna correct this huge move down. That ABC, something like that. And a rollover at that point, absolutely, that could be it. So now you get a 1, 2, 3, 4, 5. We go much lower. That's a possibility. So what I'm saying is, if we're above 5,800, let's call it 5,800 because this is the prior high here. It's roughly the 200-day moving average line. If we get back above the 200-day moving average line, we're probably good to go. Yes, we have to get above the prior high. But if we get above 5,800, we're probably going higher. The odds are definitely in. I would bet on the market moving higher if we get above 5,800. I would bet on the market moving much lower if we're down here at 4,500. Okay. If we get down here to 4,700, that's a huge buying opportunity because most of the time, every time basically since 2009, when we've hit this line, it's been the bottom. So if you buy it down here at 4,700 and it gets down to 4,500, you lost. That was your risk. Let's say that 200 points. So this is what you have to this is what you have to do to be a TSP investor. No one's going to tell you that, yeah, this is the bottom. This is when you should buy it. It's probabilities. The odds, you're trying to get in to the market when you can have an identifiable risk range. And right now, people are like, well, we're breaking out. Like, we've had 2 huge days. It's been a huge week. The market's going higher, right? Yes, in the short term, the direction is up. This is monster overhead resistance right here. And it would be an A, B, C to that point, and a very high I don't want to say probability. When you get to that point, that's a place where you need to look at it. Right now, you don't care. If the market goes up, it goes up. It goes down, it doesn't matter. If it hits 5,800 and keeps going, now it's more likely to keep on going higher. If it gets down here to 4,700 and breaks below it, it's likely to keep going lower. So anywhere in here, it can just keep moving sideways. We go into more detail than that, to be honest. In the newsletter, we're going to put some targets and the Fibonacci extensions and everything else for where we would actually be up here and down here for upside and downside targets. And you can hit both of them. It's absolutely possible that we go up, hit a target here at 5,800, which is a pretty good percentage move up. It's like, 4 or 5% up. Then come all the way back down to 4,700, hit that target, and then go back up, right? It just depends on your risk tolerance, how much you want to watch the market, all that. Okay, so that's kind of the in-the-weeds daily chart of the C Fund. So as we always put up here, now we're looking at a weekly chart, right? Weekly chart of the C Fund. Each one of these ticks, red or white, is 1 week of price movement, and this is the 20-week moving average line and the relative strength indicator. So if you're only following on a weekly basis, this is really pretty simple to do. And one of the best things to point out here, when you get a bottom at 30 in relative strength, it doesn't happen very often. It is a low in the market. It doesn't mean it's the final low, right? We got one here in June in 2022. It wasn't the final low, right? Price rallied, even right here, came back down, hit it again. But if you had gotten all in right here and stayed there, you've done pretty well, right? You could forget about the price chart. You could just manage your long-term TSP on the relative strength index. If you buy it when it hits 30 and you sell it when it hits 70, you're going to avoid the majority of the downturns and get the majority of the upturns. Relative strength is super important. If you are above that 50 line, the market's going up. If you're below the 50 line, the market's going down. So what I'm saying is there would be nothing wrong with buying here, right? And forget about the data. I mean, that's a huge, look at that weekly candle. It's huge, huge price swings. And right now it's up, 3.84% for the week. And we have a lot more room to go on the upside in relative strength. So could this be a V-bottom when you keep going? Absolutely, it's possible. Could relative strength come up to that 50 line and roll over again? Yeah. Could come up to there, hit that resistance at that 20-week moving average line, and roll right back over. You have to watch. No one's going to tell you what's going to happen. Well, plenty of people will tell you what's going to happen in the future, but you're much better off watching what's actually happening. S Fund, same kind of thing, right? We're back down. We got below 30 a little bit at the bottom, but it fell straight down. I mean, once it broke through that 20-week moving average line, that's it, straight down. It's had a good rally this week, and we'll see if it can hold it. But in the big scheme of things, it's still in this downtrend. Right? iFund, holding up definitely better than the C and the S funds, but huge volatility, right? Big down week this week, a lower low intro week, and then by the end of the week, huge move. That was a few weeks ago. And then another big move up this week. So where iFund's holding up, what's kind of ironic is that the reason that's happening is because investors are fleeing U.S. assets. Most of the rest of the world is decreasing their interest rates. Their economy is much worse than ours. They're decreasing rates to try to boost their economy, and yet the emerging market stocks are going up because their central banks are decreasing rates. That's why investors are clamoring for the Fed to cut rates, because that'll push our stock market up, because it pushes liquidity into the system. So just because the iFund is going up relative to the CNS does not mean that the iFund is just going to keep on going higher. And the F fund, I mean, who knows? Bonds are all over the place right now. This was a great looking breakout. It failed and then recovered, and now we're back to basically trying to find support at that 20-week moving average line. It's very tough if you're a fixed income, if you're a bondholder. It's very hard. Yeah. And then if you don't want to deal with any of the stuff, the G fund always goes up and to the right.
G fund for the win. Questions. If you have questions, put them in the comment section wherever you find the video. Hey, if you like this video, if you hate this video, either one, share it with your friends. Let them be the most educated person in the room besides yourself. We really do this so we can get the word out to people that you can manage your TSP. You don't have to just set it and forget it and walk away. We see so many, I want to say literally thousands of people in our Facebook group. We have 40,000 people in there, and so many of them come in, and their first thing they say is, 10 years ago I did X, Y, and Z, and I've never looked at it again. Mm-hmm. And it's so disheartening, because you can do this. It doesn't have to be a daily thing. You don't have to be obsessed with it. You can manage your TSP account and do well for a 20, 30-year career. If you like that, go check our website out. We'll talk to you guys soon. Hope you have a great week.
Alrighty.
And we're out of here.